what we agreed is that you attempt that question. In case of any problem, you let me know. Now, in today's session, I want us to proceed and basically we look on the second type of earnings per share, and that is basically the diluted earnings per what? Per share. So the first thing we need to ask ourselves here, what is a diluted earnings per share? Or which companies or which corporates are required to compute this diluted earnings per share? Now, a diluted earnings per share basically is an earnings per share which is computed by those companies which are having something called the potential ordinary share. So therefore, this is a diluted earnings per share computed by companies having potential ordinary what? Share. So therefore, this is EPS, which is basically computed by companies having something called a potential ordinary shares, potential ordinary shares, and basically these ones are abbreviated as a POS, potential ordinary what? Shares. So maybe we need to ask ourselves here, what are potential ordinary shares? What are potential ordinary shares? Potential ordinary shares basically refers to any financial instrument which is issued by a company, or basically any contract which the company has entered into, and which requires the company to issue ordinary shares in future. It's a contract the company has already entered into, and that contract requires the company to issue some ordinary shares in the future, or it is a financial instrument issued by the company requiring the company to issue ordinary shares in what? In the future. So that such contract, such financial instrument, we refer to them as a potential ordinary shares. So we are saying that this is a contract or basically a financial instrument which basically has been issued by the company, or basically a contract which the company has entered into, and which requires the company to do what? To issue ordinary shares in what? In future. It is a contract the company has entered into. That contract requires the company to issue ordinary shares in the future, or it is basically a financial instrument issued by the company requiring the company to issue ordinary shares in what? In the future. Now, what are good examples of these potential ordinary shares? What are examples? Examples of potential ordinary shares. Basically, these include, let's start by looking on this contract. This includes something like a stock option, a stock option. In other terms, we refer to this as the stock warrant. Now, if you can be able to recall in our previous class, I think we came across this particular term here, the stock option, or basically the stock warrant. And I've said that this is an agreement or is a contract between the company and the employees, that the employees of the company will be given a privilege, will be having a right to buy the shares of the company in the future at a price below the market price. Now, that one is a good example of a potential ordinary share because it is a contract between the company and the employees. That contract requires the company to issue ordinary shares to the employees in the future. It is a good example of a potential ordinary share. So then also we have this financial instrument, and basically these include the convertible securities. The convertible securities, e.g. the convertible debentures, the convertible loan stock, etc. So any convertible security is basically a financial instrument which has been issued by the company, and that financial instrument basically requires the company to issue ordinary shares in what? In the future. It is a financial instrument issued by the company and which requires the company to issue ordinary shares in what? In the future. So why are we saying that these convertible securities requires the company to issue ordinary shares in the future? Generally, what we know is that if, for example, you have invested in a company in terms of buying convertible debentures, convertible bonds, convertible loan stock, you have the right to convert them into ordinary shares. So if, therefore, during the current year, you have bought some convertible debentures, it basically means that you have the right to convert them into ordinary shares of the company in the future. So therefore, that is an instrument, is a financial instrument which has been issued by the company and which requires the company to issue ordinary shares in future once the holder of these securities convert them into ordinary shares. And therefore, what you have said is that the diluted earnings per share is basically earnings per share which has to be computed by companies which have got potential ordinary shares. So why are these companies required to compute the diluted earnings per share? The reason why they're required to compute the diluted earnings per share is because eventually, once these ordinary shares are issued in the future, they will have to dilute the interest of the current shareholders, assuming we are the only shareholders of the company. If we are the only shareholders of the company, it basically means that we have 100% shareholding in that a company. But if this company happens to issue other shares in the future, and those shares will not be issued to us, it basically means that our interest will be diluted. We will not be having 100% shareholding because we have other shareholders who are coming in. So our shareholding in that company will do what? We reduce. So if we had 100% shareholding, it can reduce to 80%. It can reduce to what? To 90%. So therefore, any company which is likely to issue ordinary shares in the future, because it has entered into maybe such contract, or maybe the company has issued such financial instrument, this company has to compute the diluted earnings per what? Per share. Now, how do we compute this diluted earnings per share? So the diluted earnings per share, basically the DEPS, this one will have to be computed, by adjusting the PATOS and one-offs, which are used in the computation of what? The basic earnings per share. So basically what we do is that we adjust these two values, the PATOS and one-offs, which are used in the computation of basic earnings per share. Recall basic earnings per share. This one is computed by taking the PATOS divided by what? By one-offs. This is something we already know. So how do we compute the diluted earnings per share? The diluted earnings per share is basically computed by taking what? By taking the PATOS divided by one-offs. But now to this PATOS, we add something called the increase in earnings. Increase in earnings, and be able to explain what is that. And then to this, we add something called the increase in number of what? Shares. The increase in number of what? Shares. So this is basically how we compute the diluted earnings per share. Remember what we are saying here. We compute this diluted earnings per share by adjusting PATOS and one-offs, which is used in the computation of what? Basic earnings per share. Now, what do we mean by increase in earnings, increase in number of shares? Now, for you to be able to understand that, let's take a small example here, and we assume that we have a company here that is company X, and this company, for example, has issued convertible debentures. Our company has issued convertible what? Debentures. Convertible debentures. Basically, what we know is that these debentures will have to be converted into ordinary shares of the company what? In the future. In what? In the future. But the first thing which is important for you to understand here is that when computing this diluted earnings per share, for us to be able to compute the diluted earnings per share, we compute it on an assumption. We make an assumption that these convertible debentures were converted into ordinary shares during the current year. So therefore, that is very, very important that diluted earnings per share is computed on something called what if scenario. What if these convertible debentures were converted into ordinary shares, or it is computed on the assumption that these convertible debentures were converted into ordinary what? Shares. So if they were converted into ordinary shares, then we ask ourselves, what would have happened? So if these convertible debentures were converted into ordinary shares, then two things would have happened during the current year. Number one, the number of ordinary shares issued by this company automatically would have increased because the holder of the debentures converted them into ordinary shares. So the number of ordinary shares issued by the company would have increased. Number two, we know that the holder of these particular debentures are automatically entitled to receive some interest from the company, or basically entitled to receive some return from the company, which is known as interest. Now we know interest, this one is an expense. But now, if these convertible debentures were converted into ordinary shares during the current year, it is obvious that this interest will not have been paid. Is that the position? That interest will not have been paid because all the debentures were converted into ordinary what? Shares. And if that interest will not have been paid, which is basically an interest, it basically means that the profit for the current year, equally this profit would have increased. Would have done what? Increase. So therefore, for us to be able to compute this diluted earnings per share, once you come across a potential ordinary share like the convertible debentures, for you to be able to compute the diluted earnings per share, you compute it on what if scenario, or basically compute it on the assumption that these convertible debentures were converted into ordinary shares. We are saying if they were converted into ordinary shares, two things would have happened. Number one, number of ordinary shares issued by the company would have increased. Number two, the profit for the current year would have increased simply because this interest payable to the debenture holders would not have been paid. The debenture holders converted their debentures into ordinary shares. they will not have been paid, or basically the company will not have paid that particular word interest. So therefore, two things: increase in earnings, increase in profit, and also increase in number of what of shares. And therefore, here when talk about the increase in earnings, we are referring to that particular amount by which the profit would have increased with if our debentures were converted into ordinary shares. And basically, we are going to look on how do we compute that increase in profit, or how do we determine the amount by which the profit would have increased with. We are going to discuss on that. We're going to look on how we compute that. So therefore, this increase in earnings is the amount by which the profit would have increased with, assuming our debentures would have been converted into ordinary shares. Then increase in number of ordinary shares. This refers to those number of ordinary shares which would have been issued to the holder of this particular convertible debentures if they converted them into ordinary shares. They would have been issued with how many ordinary shares? So once you have computed those shares which would have been issued, the amount by which the profit would have increased with, you basically compute the diluted earnings per share using this formula. Using this word, using that formula. But there is something I've insisted on, which you have to understand here. We compute this diluted earnings per share on an assumption that the potential ordinary shares of the company were converted into ordinary shares during the current year. Now, in this case, we have various types of potential ordinary shares, and briefly, I want us we look on them, we highlight them, and of importance, what you need to understand as far as each potential ordinary share is concerned is basically how we compute these two items: increase in earnings, increase in number of shares. So here we have, remember, I've already given examples of potential ordinary shares here, and maybe I can just list all of them here. Potential ordinary shares, this will include stock options. Stock options, they can also be known as the stock warrants. Number two, we have the convertible, let's talk of convertible debentures. We also have convertible loan stock, and also the convertible bonds. So these ones are treated in the same way. In the computation of diluted earnings per share, we treat them in the same way. And then number three, we have the convertible preference shares. The convertible preference shares. Number four, we also have yes, I think majorly we can talk of those, although we have others. But if you check on the questions which are usually tested at your level, you usually come across maybe those three. So let's just talk of those three. Let's talk of those three. But if you check on the notes, I think I've captured others, like maybe the partly paid shares. And let me also add this one. Let me also add this one. Something called the contingency issuable shares. Issuable shares, because you also need to understand this. I think there is a theory question which is in the past papers, whereby the examiner was requiring the candidate to explain what are contingently issuable shares. Contingently issuable shares. So I want us to start by looking on let's start by looking on this: the convertible debentures, convertible bonds, convertible loan stock, convertible loan notes. All these are treated in the same way, because all these are debt instruments. And if the company has issued this debt instrument, the company has to pay what? Has to pay interest. Now, how do we compute the diluted earnings per share in case the company has issued these convertible securities? Now, remember, first of all, you're saying, in case you come across a question and you're told the company has issued any of these convertible securities, the first thing you need to do is to make an assumption that those particular convertible securities were converted into ordinary shares during the current year. If you make that assumption, then you need to proceed and you compute two things. One, you need to compute something called the increase in earnings, increase in what? In earnings. And basically, in this case, I've said increase in earnings. This refers to the amount by which the profit, which is basically attributable to the ordinary shareholders of the company, would have increased with, on the assumption that these convertible securities were converted into ordinary shares. So if the convertible debentures, bonds, and loan notes were converted into ordinary shares, the profits attributable to ordinary shareholders would have increased with how much? Now, in this case, we know if the company has issued any of these convertible securities, the company usually pay interest. So therefore, in this case, we say the increase in earnings is equal to the interest which was paid. The interest which was paid And basically that interest, we take it net of tax. We take it net of tax. So to get that interest net of tax, we multiply that with 1 minus tax rate. Reason being that interest we know is allowable expense. In other terms, interest is always deducted before tax. Is always deducted before what? Tax. So the profit for the current year would have increased with the interest which was paid, but net of tax. Net of tax. So that's basically how we compute that. Number two, we also need to compute something called the increase in the number of shares. Increase in the number of shares. So when talk about the increase in number of shares, basically, we're referring to the number of ordinary shares which would have been issued by the company to the holder of these securities. If these securities were converted into ordinary shares, how many ordinary shares would have been issued on conversion? So this one is basically computed. This one is usually computed. This one is usually computed using, this one is computed using what? Using the conversion rate. Using the conversion rate provided. Using the conversion rate provided. Using the conversion rate provided. So always in this case, you'll be given the conversion rate. You'll be given the rate at which these convertible securities can be converted into ordinary shares. And basically use that conversion rate to compute how many ordinary shares would have been issued if those convertible securities were converted into ordinary shares. So that's basically how we deal with this. So then from there we have the convertible preference shares. Convertible preference shares. So basically convertible preference shares, these are those preference shares which can be converted into ordinary shares. How do we compute these two items here? How do we compute these two items? Because remember what I've said here, as far as all these potential ordinary shares are concerned, when it comes to computation of diluted earnings per share, what is important? And basically what will give you marks in an examination setup is how to compute this. Increase in earnings, increase in number of what? Of shares. That's that? Yes, that's what you need to understand. You need to understand. So the increase in earnings here, the increase in earnings, this one is basically equal to what? We first of all ask ourselves, if the company has issued convertible debentures, or sorry, not debentures, sorry, the convertible preference shares, what does the company pay to the holder of these shares? So we automatically know that the company pay dividends. Pay what? Pay preference dividends. So the increase in earnings, this one is equal to the preference dividends, basically for the year. The preference dividends for the year. Do we take that dividend net of tax? No, simply because dividends are deducted after tax. In other terms, dividends are not tax allowable. That's what basically we know. So then we compute the increase in number of shares, the increase in number of shares, and this one we computed just like what you have said up there. This one is computed using the conversion rate provided, using conversion rate which is provided, using the conversion rate provided. So we'll be given the conversion rate to determine how many ordinary shares would have been issued, assuming that our convertible debentures, convertible preference shares were converted into ordinary shares. So then from there we have number three. Number three, we have the stock options. Stock options, or basically the stock what? The stock warrant. The stock warrant. The stock warrant. Warrant. Now, what do you mean by the stock option, or basically the stock warrant? So these are privileges which are given to the employees of the company to buy the shares of the company in the future at a price below the market price. Now, if you can be able to recall what we said in a previous session, that is on Saturday. Was it on Saturday? Yes, I think so. Yes, I think so. So basically what we said is that these stock options or these stock warrants are also used in the computation of basic earnings per share. And actually in this case we say we use this in computation of basic earnings per share once they are exercised during the current year. For example, the employees have been given a privilege to buy the shares of the company at a price below the market price. And during the current year, they have exercised the stock option. Exercising stock option means they have bought the shares of the company at a price below the market price. And I hope you can be able to recall what we said we do in relation to that. We said once the company has issued shares at a price below the market price, some of the shares are assumed to be issued at full market price, others are assumed to be issued free of charge. And therefore, we said The shares which are issued here to the employees will be split into two. Shares issued at full market price and the shares issued at nil what consideration. And I think I gave you the formulas for computing the same. Now, here we use the stock option or basically the stock warrant to compute the diluted earnings per share if these ones will be exercised in the future. So we can say this is used in computation of DEPS if they will be exercised in the future, or if they have not been exercised at the end of the year. If they have not been exercised at the end of the year. At the end of what? Of the year. So if they have not been exercised at the end of the year, it automatically means that the employees will be exercising those stock options in the future. In what? In the future. So the company will have to issue ordinary shares in what? In the future. So this is very important that the stock option or the stock warrant only qualifies to be potential ordinary shares if they will be exercised in the future. If they will be exercised in what? In the future. If they were exercised during the current year, we only use them in the computation of basic earnings per share. But here we only use the stock option, or we use the stock option, the stock warrant in the computation of DPS, which will be exercised in the future. Which will be exercised in what? In the future. Equally, having known that, we also need to look on how we compute these two items. We can start with the increase in earnings. And basically, for us to be able to compute these two items, increase in earnings, increase in the number of shares, increase in earnings, increase in number of shares, here, we equally assume, someone, I think I can see a question here from Awino, you're saying IDP. So remember what I've said here, stock option, we have said is a privilege which can be given to you as an employee to buy the shares of the company at a price below the market price. Now we are saying this stock option, if you can be able to recall what we said in our previous class, we also use them in the computation of basic earnings per share. But we use them in the computation of basic earnings per share once they are exercised during the current year. Being exercised means the employees of the company bought the company shares at a price below the market price. That is the first thing you need to remember. But that one applies to basic earnings per share. Now, when it comes to diluted earnings per share, these stock options, this stock warrant will only qualify to be potential ordinary shares if they have not yet been exercised at the end of the year. If they have not yet been exercised at the end of the year, what does that mean? It means that the employees will be buying the shares of the company in the future. In other terms, the company will be issuing the shares to the employees in what? In the future. So therefore, that is the first thing you need to consider when computing the diluted earnings per share. Have they been exercised or not? If you're told the company has granted the employee stock options, but at the end of the day, they had not been exercised, in that case, you will not use them in the computation of basic earnings per share, but they qualify to be potential ordinary shares. That is the first thing you need to understand. Then from there, you need to compute these two items here. I hope that is clear, we know. So you need then to proceed and compute these two items here. Increase in earnings, increase in number of what? Of shares. Increase in earnings, increase in number of what? Of shares. But now, for us to be able to compute these two values, just like what you have said, in relation to these other potential ordinary shares, we will have to make an assumption. Which assumption are we going to make here? The assumption we are going to make here is that these stock options were exercised during the current year. That is an option we are going to make. And if they were exercised during the current year, then we ask ourselves, what would have happened? So, for example, would the profit of the company be affected? Or will there be some savings by the company? Because now this increase in earnings, I hope you have seen, is basically the savings which the company will make. For example, you're saying if the convertible debentures are converted into ordinary shares, automatically the company will not pay the interest, which is an expense, which is a saving to the company, and that makes the profit to increase. If the convertible preference shares are converted into ordinary shares, the company will not pay preference dividends. That is a savings to the company. Now, in our case here, we ask ourselves, if the employees have been granted a privilege to buy shares of the company in future at a price below the market price, if they exercise that stock option during the current year, will there be any savings by the company? Let me get the answer here from you. If the employees exercise this stock option during the current year, will there be any savings by the company? Now, for you to be able to know whether it is yes or no, you need to ask yourself here, If, for example, you are an employee of a company and you have agreed with the company that you have a privilege, you have a right to buy the shares of the company in the future at a price below the market price, are you entitled to any form of return from the company? Like the holder of debentures, we know the holder of debentures are entitled to interest. If they convert them into ordinary shares, they will not be paid that interest. The company will save. So if you are an employee, you have been given this privilege to buy the shares of the company in the future. Are you entitled to any form of return from the company as a result of being guaranteed that option? Are you entitled to any form of return from the company? Automatically, no. So you'll only be able to maybe receive dividends once you buy those shares. But until you have bought the shares, there is no any return you're entitled to. You have just agreed with your company that once you meet a number of conditions, then you'll be able to buy the shares of the company. So you're not entitled to any form of return. And therefore, even if you exercise the stock option during the current year, you buy the shares of the company during the current year, there will be no any savings from the company. There will be no any savings by the company. So because the company is not paying you anything. So therefore, the increase in earnings here, you need to remember this is always zero. Is always what? Zero. There is no any savings by the company. Then from there, we compute the increase in number of shares. So the increase in number of shares here, the first thing you need to recall, if the employees exercise the stock option during the current year, they will buy the company shares at a price below the market price. So if they buy the shares of the company at a price below the market price, you have to recall what we said at the basic earnings per share. Anytime the shares are issued at a price below the market price, the shares must be split into two. The shares issued at full market price, issue at full market price, and number two, the bonus element. The bonus what? The bonus element. So these are the shares which will be issued free of charge. These are the shares which will be issued at full market price. Now, these particular shares here, we say basically shares basically are ignored for the purpose of computing the diluted earnings per share, simply because these are like the normal shares which are issued by the company at a full market price. In other terms, we say that these shares are not dilutive. Being dilutive means what? Those shares, they do not reduce the earnings per share of the company. Reason being, the company issues shares here at full market price. The company receives some amount of money which is invested. So if the money is invested, there is increase in earnings, and also there is increase in number of shares. You see, basically we know in computation of earnings per share, we take the profit. This is the simple formula for computing this one. We take the profit, we divide that with the number of shares. The number of what? Shares. Now we are saying, in case of the shares issued at full market price, these are the shares the company will issue, and the company gets money equivalent to market price of the shares issued. So it basically means that the number of shares issued will increase. Number two, because the company has received additional resources, additional amount of money equivalent to the market price of the shares issued, the company has undertaken additional investment. So as a result of that, the profit of the company will do what? Will increase. So if you increase the profit and also the number of shares, most likely the earnings per share may not even be affected. The earnings per share may remain the same, or it can do what? It can do what? It can remain the same, or it can do what? Increase. So that's why we say that these shares are not dilutive. They do not reduce the earnings per share. Not dilutive. Not dilutive. And therefore, during the computation of diluted earnings per share, they are ignored. So therefore, what we use here, in addition to the stock option or stock warrant, are the bonus element. Bonus element, these are the shares which are basically which will be issued free of charge to the employees if they exercise the stock option during the current year. And in terms of how we compute this bonus element, we apply the formula which I gave you in a previous class. The total shares, how many shares would have been issued to the employees if they exercise the stock option during the current year, minus the issue at full market price. And I hope you can be able to recall there is a formula which I gave you for this, how to compute the shares issued at full market price. We compute how much amount would have been received from the employees. And remember, in this case, we are making an assumption that the employees exercise the stock option during the current year. So we ask ourselves, how much amount would have been paid by the employees? So automatically we take the shares which would have been issued to them times the amount they were to pay per share. So that will give us the amount which would have been received from them, and then you divide that with the average market price per share. So that will basically give us the shares which would have been issued to the employees free of, or actually at full market price. So once we take this minus this, we get the bonus element. And basically, this bonus element, this now what is used in the computation of used in computation of diluted earnings per share. So therefore, to make this one simpler, we say that the increase in earnings here is equal to the bonus element. Is equal to the bonus what element? You don't have to remember all this. Is equal to the bonus element. Then from there, you also need to remember this formula. The formula for computing the bonus what element. So if you can be able to remember that, it becomes quite simple for you. So therefore, you need to understand this. I think this is one of the areas where majority of the students don't get it right, but basically understand what you have discussed there. Now, finally, I want us to discuss on this, which is basically similar to this, and then we do a question. Contingently issuable ordinary shares. Now, when talk about contingency, this comes from the word contingent or a contingency. What is a contingent or a contingency? So basically, this a contingency or a contingent is an event which may or may not happen in the future. An event which may or may not happen in the future. So therefore, these are usually those particular shares which the company basically is supposed to issue to mostly the senior managers or the senior employees once they have met a certain performance target. Like assuming in this case you are a manager in charge of a certain branch. So you may agree with your employer, with your company, that if the profit of that branch exceed a certain amount, then you'll be given a privilege to buy the shares of the company at a price significantly below the market price. Now, those shares which are likely to be issued to you, we refer to them as contingently issuable ordinary shares. So these are the ordinary shares which are usually issued to the senior employees or the managers if they meet a certain performance target which has been set by the company. Now, these particular shares are basically treated in the same way, just like a stock option or basically stock warrant. The only difference is that these shares here or these are privilege given to the ordinary employees, but this is a right given to the senior managers to buy the shares of the company in future if they meet the performance criteria which has been set by the company. But in this case, these shares will only be used in the computation of diluted earnings per share if two conditions have been met. Two conditions have been met. Number one, the performance criteria which has been set by the company has already been met. For example, you're a manager in charge of a certain branch, and basically you have agreed with the board of that company. If the profit of that branch exceeds a certain amount, you'll be given a privilege to buy 10,000 shares of the company at a certain price, which is significantly below the market price. You see, these are benefits which is given to you to encourage you to continue working hard as a manager in charge of that branch. Now, in this case, we are saying these shares will only be used in the computation of diluted earnings per share, number one, if the performance criteria agreed between you and the board of that company has been met. Number two, these shares have not been issued to you. You have met the performance criteria, the shares have not been issued to you. So the shares automatically will have to be issued to you in the future. You have already met the set criteria, you have not been issued with the share, automatically the shares will be issued to you in the future. So if the shares will be issued to you in the future, for us to be able to compute this, we assume that you were issued with the shares during the current year, and then we compute these two items. Increase in earnings, which is always zero. The increase in number of shares is equal to the bonus element. Yes, but there is a small theory question I think I'd seen in relation to this, where the candidates were required to explain what are contingently issuable shares. I've said that these are shares to be issued to the senior managers or to the managers or basically to the senior employees of the company once they have met a certain performance a certain performance criteria which has been set by who? By the company. I've said, and there is no difference in terms of how we compute the bonus element. And basically, at what we discussed, as per what we discussed at the basic earnings per share. If you check on the formula I gave you in our previous class, it's the same. Total shares, which would have been issued to the employees, minus the shares issued at full market price. Shares issued at full market price, amount received by the company, minus divided by average market price. Average market price. Can share premium be issued? What do you mean by that, Fred? Can a share premium be issued? Fred, what do you mean by that? rephrase your question. Can a share premium be issued? We don't have something like that, Fred. Maybe you rephrase your question, sir. You rephrase. Yes. As we wait for Fred to rephrase his question, I want us to go straight to a question now. I want us to do a question and then we finalize on this. So maybe we'll just do one question and then we will revisit this topic. This is a topic which was tested last sitting. So the chances of the topic being repeated are slim, but basically we don't ignore this topic. If you check on how the papers for last sitting were tested, so the examiner nowadays is trying to test all the topics. Like if you check on the paper for last sitting, is one of the challenging paper. Reason being that the examiner didn't bring those long questions, like a question for cash flow having 20 marks, a question for group. So, but what the examiner did, he brought so many questions from different topics. So nowadays, moving forward, that's basically what you need to note. Because if you check on how the exams have been tested in the past, the examiner, or actually the student could even be able to predict that if cash flow is not there, this sitting, it will be there and it will be a question for 20 marks. So the student could basically be able to predict that and basically do what? And just revise some few topics and pass. But I think the examiner is trying to change all that. And also, Kasneba is saying that they're receiving some negative feedback from the market that most of the CPA graduates are not competent. Maybe that's why they're trying to tighten what? They are trying to make those particular exams a little bit comprehensive. Basically, they are trying, the exams are trying to test across the board. So moving forward, so that is maybe something you need to note. And maybe for those who did like this paper, AFR, you can be able to attest to that. That paper was not the same with the previous papers. That's yes. So moving forward, you can't say that because this topic was there, it will not be tested. So you need to be revising revise our topic. So I want us to start with this question here. December 2024. December 2024. Well, Fred, we don't have shares which are known as share premium. Fred, we don't have shares which are known as share premium. Fred is share premium is a type of a share. No. We don't have a type of a share which is known as a share premium. Share premium basically is whereby the shares are issued at a price above what? Above the par value, but we don't have a share known as a share premium. Yes, Fred. Yes, can we take a short break or we just continue? We take a short break for 5 minutes or we could just continue. Yes, Sahin, the paper for last sitting was a tricky one. And this didn't only apply to AFR, it applied to so many papers. Okay, so we then take a short break. As we come back, make sure you have this question with you. December of 2024, question number 3B. Question 3B, we just take a short break of 6 minutes. We come back exactly at 7. We come back at exactly at 7. 7, we'll be back. Yes, we continue. I hope you're back. We continue. So we go through this question first of all. We see what you are told and equally what the examiner was requiring. So we go to part B of the question we are told. The following is an extract of the statement of financial position of Birika Limited as at 31st of August 2024. So we have some balances there. We have ordinary share capital, share premium, retained earnings, total equity. Then we have non-current liabilities, which include 14% convertible notes and 9% bank loan. We have some additional information. Number one, you're told the company reported a total profit of 31 million, that is 31,810,000 for the year which ended 31st of August 2024, which included a loss of 4.16 million from independent business operation that was discontinued during the year. Number two, on 1st November 2023, the company issued 3.15 million new ordinary shares at fair value as a consideration for the acquisition of a new property for 3 On 1st January 2024, the current ordinary shareholders were invited to subscribe for a right issue on the basis of 1 share for every 2 shares which were held at a price of 15, when the market price per share on camera rate basis was 24. These are right issue. Remember, I said that these are concepts you will come across in all questions for earnings per share. So number 4, you're told the 14% convertible notes in issue is convertible into ordinary shares at the holder's option on the basis of 50 ordinary shares for each shillings 100 of the roll notes. On 1st March 2024, holders of shillings 20 million of the convertible notes exercise their conversion option. 5, the corporate tax rate applicable to Birika Limited is 30%. What are we required to do? Part A, we are required to calculate the basic earnings per share, BEPS, for the year which ended 31st of August 2024, sorry. And Roman 2, we are required to compute the diluted earnings per share for the year which ended 31st of August 2024 for marks. We start with the part A. And basically part A of that particular question, what are we required to do? We are required to compute what? We are required to compute the basic earnings per share. We are required to compute the basic earnings per share. The basic earnings per share for the year which ended 31st of August 2024. So the first thing we need to recall here is basically the formula. How do we compute these basic earnings per share? So to compute the basic earnings per share, we said we take the PATOS, the profit attributable to ordinary shareholders. We basically divide that with 1 loss, weighted average number of ordinary shares. So that is the first thing you need to recall. We need to start by computing this one, the PATOS, which is basically the profits attributable to ordinary shareholders. Recall the formula for this. We said we take the profit after tax, also known as the net income, also known as the profit for the year. The profit for the year. And basically to this, we said we less the preference dividends. The preference dividends for the current year only. Number 2, we also less the profit attributable to who? To the non-controlling interest. And then to this, we said we add any loss from discontinued operation, any loss from the discontinued operation. So that basically what you just need to recall as far as the computation of the PATOS is concerned. So, and I think you're given information in relation to this in note number 1. Let's go to the additional information number 1. Additional information number 1. And we are told in note number 1 that the company reported a profit of 31.81 million for the year. That is the profit for the year in other terms. And I think we can work with our figures in thousands of shillings. So mean that this one was 31,810,000. That is basically the profit for the year. And then you're told which included a loss of 4,060,000 from independent business operation, which was discontinued. That is the loss from discontinued operation. That loss from discontinued operation, remember, should be added. That's what we said. And that is an amount of 4160. Then if you check on this particular question here, this is basically a single company. If you can recall the other question we did, it was a question for a group of companies. That's why here we're given information for Birika Limited. It's a single company. So if it's a single company, automatically, we don't have the profit attributable to NCI. The profit attributable to NCI, we say that this one is only applicable. You'll only be given this whereby you are computing the earnings per share for a group of companies. So these are single company. So that's why we are saying we don't have that. Then we need to check whether this company had issued any preference shares. Where can we get that information? We can only get that information below what we have below paragraph 1 of our question. We are told the following extract is for the statement of financial position of this company is at 31st of August 2024. And there was a problem with that date. That date should be 31st of August 2023, the end of the previous year, because those should be the opening balances. So if you have the physical paper, can you change that to 2023? Those should be the balances at the end of the previous year, which should be the opening balances during the current year. That's that? Yes. So that should be the balances should be at the start. So now if you check on what you're given here, you'll be able to see specifically at the equity, this company had not issued preference shares. So if the company had not issued preference shares, automatically there were no preference dividends which were paid. No preference dividends which were paid. So having that, we need to move and basically we compute what? We compute the patos. So what will be the patos? We basically need to add these two values here. And basically that will be what? That will be 35, 9 what? 35, 970. Are we getting that value here? Yes, 35, 9 what? 70. So having that, we then move and compute the one-offs, the weighted average number of ordinary shares. So how do we compute this one? We said we compute this by first of all determining how many ordinary shares were issued. That is, yes, how many ordinary shares were issued and fully paid at the start of the year. We add the other shares which were issued during the current year. Remember what you have said. The information which you have below paragraph 1, those are opening balances. That's why I've said there was a problem with that date. Because actually this question was a repetition of another question. So I know that. So those are opening balances. So whatever you have below paragraph 1 are opening balances. And basically from what we have there, we can be able to get the shares issued by our company at the start. Remember, this year ended on which date? 31st of August. So basically it means that the next year will start 1st September. So this year therefore started 1st of September, but basically 2023. So what we need to do here is we start with the shares which had been issued. The number of ordinary shares issued and fully paid as at the start of the year. As at the start of what? Of the year. As at the start of the year. Ida is asking, was the loss included? Ida, the point is very clear. I hope you have seen that, Ida. Point 1. Have you seen what you're told? The profit for the year that 1.810.81 million for that year, 31st August 2024, which included. Can you see that one, Ida? Yes, which included. Yes, we said, I think I explained why Ida we add back. Ida, did I not explain? I explained that. The reason why we're adding back the loss is because in arriving at this figure here, this loss has already been deducted. You see, a loss reduces the profit. Is that the position? So this loss in arriving at this, it has already been deducted. In other terms, this loss, because it is included here, it reduced this profit. And basically what we say is that in computation of both basic and diluted earnings per share, we don't use any profit or loss from discontinued operations. We only use the profit or loss from continuing operations. So this loss, because it is included here, it reduces that profit. That's why we are adding it back. Sasa? Yes. That's why we are adding it back there. So because it's already included there. Okay. So basically, let's come back here. We need to start by determining how many ordinary shares have been issued and fully paid at the start. I've said we get that information below paragraph 1. So, and I've said those balances which we have there are at the end of the previous year. That's why I've said that date should be 31st August 2023. So, meaning that if there were closing balances in the previous year, during the current year, there will be opening balances. And I hope you can see we are given ordinary share capital. Remember here, we purely deal with the number of shares, not their value, purely the number of shares. We will take the ordinary share capital, which is basically 94,500. We basically divide that with the par value. I hope you can see the par value still where we have that ordinary share capital, which is basically what? 10. So the reason why we are dividing these two values is for us to be able to know the number of ordinary shares which were issued and fully paid at the start. And remember our figures now, there will be in thousands of shillings. So those are ordinary shares issued and fully paid at the start. Now to this, we need to go to the additional information number 1 all the way to note number 5, and basically we identify the shares which were issued during the current year. And I think we will go straight to note number 2, because in point number 1, you are given that profit. In note number 2, what are we told? We are told on 1st of November 2023, the company issued 3.15 million new ordinary shares at fair value. Remember, fair value is the market price. At a fair value as a consideration for acquisition of a new property. So these are shares issued by the company at full market price, or shares which are issued by the company in payment of purchase consideration. Recall what we said in our previous class. Those shares are supposed to be weighted on time basis. So therefore, that one is quite simple. We write the date of the transaction here, 1st of November 2023, and basically we can say there was issue at a fair value, which is the same with the issue at full market price. The shares which were issued there were 3,150,000. And now what we need to do to these shares is we weight them on time basis. That's what we said. Shares issued at full market price must be weighted on time basis. These shares were outstanding for how many months? Were held for how many months during this year? They were held in November, December, but this basically for 2023. And then remember when the year is ending, it is ending 31st of August 2024. In 2024, they were held for 8 months. They were held for 8 months. So in total, these shares were held for 2 months in 2023, 8 months in 2024. That is a total of 10 months. So they were held for 10 months out of 12. Out of 12. And basically that will give us what? That will give us what? That will give us what? What are you getting here? 26, 25. 26, 25. So let's move to the other point, number 3. Point number 3, we are told on 1st January 2024, the current ordinary shareholders were invited to subscribe for a rights issue. So basically what we have there, even before we proceed, we are told on 1st of January 2023, there was a rights issue. Now, there is something I said in our previous class, that in all questions for earnings per share to come across in an examination setup, the examiner will test this concept. The examiner will test this what? Concept. Because we say two things here. Most of the students are not able to split the shares into the two components, issue at full market price and the need consideration. And number 2, most of the students are not able to compute the theoretical ex-right price. So therefore, we say in case of a right issue, the shares here must be split into two. The issue at full market price, and then the bonus element. The bonus what? Element. The bonus element. The bonus element. So what are we told here? We are told here that the company invited the existing ordinary shareholders to subscribe for a rights issue on the basis of 1 share for every 2 shares held at a price of 15 when the market price per share was 24. Now, unlike the other questions which we did here, number 1, we are not even told how many shares were issued during the rights issue. The first thing we need to do here is to determine how many shares were issued by the company during the rights issue. And number 2, we compute the theoretical ex-right price. Those are the 2 things we need to do even before we proceed to split our shares into 2 components. So the shares issued during the rights issue and the theoretical ex-right price. Because we are told during this particular rights issue, the company was to issue 1 share. The company was to issue 1 share for every what? For every 2 shares which were held. 2 shares which were held. Now, in this case, we need to go back to our working here, and basically we determine before the rights issue, how many shares were held? In other terms, before this rights issue, how many shares had been issued by the company? Just like the other question which we did, we said you can't get that information in the question, you can only get it in the workings here. How many shares had been issued by the company before the rights issue? Before the rights issue, I showed you how to compute that. Yes, we said take the shares which had been issued at the start, and then you add the shares issued here. The shares issued here are not these ones. They are this. That one what? 50. We say don't take this one. If you take that value, you get it wrong. So the shares issued there were that one what? 50. Are we together on that? Yes. That is the same thing we did in the other question. So we take 9450 plus 3150, and basically that will give us what? That will give us 12,600. So those are the shares which were held. So we cross multiply, then we divide. So we have 1 times 12,600. 1 times 12,600 divided by 2. And that will give us what? That will give us what? That will give us 6,300. 6,300. So basically, these are the shares which were issued by the company during the rights issue. Now, having done, we need to move and we compute the theoretical ex-right price. Now, for us to be able to do this, we're going to use the same approach we used in the other question. So how many shares were held before the rights issue? The shares which were held before the rights issue, before the rights issue, the shares which were held, we know, were these ones. That is 12,600 shares. What was the market price per share? The market price per share before the rights issue, if we go back to point number 3, market price per share before the rights issue was how much? Can you see it was 24? Can you see that? Which is called the CAM rate, the market price per CAM rate basis. It was 24. I hope you can see that. Then during the right issue, how many shares were issued? During the right issue, the shares issued were these ones, 63. And basically, these shares, they were issued at a price of, can you see that? At a price of what? Ida. Can you see that? Sahin, Stephen Patrice. Can you see that? Yes, at a price of 15. So just like what we did in the other question, we will do the same. To compute the theoretical exercise price, we compute something called the market capitalization, the total market value of all the shares. We will take the shares which were issued before the right issue, 12,600, times this one, which is basically 24. We add the market value of the shares issued during the right issue, 63, times 15, and then we divide that with the total shares issued, which will be these ones plus this. That is 12, 6 plus what? Plus 63. That basically gives us the theoretical X-rate price. The same approach we used in the other question. We used in the other question here. We used in the other question. So let's get the final values here. The final value. What are you getting? Yes, you're getting what? That is 18. 21 shillings, yes. So this will be 21 what? 21 shillings. 21 what? 21 shillings. So remember, you said always there is a mark for that. Yes. So having that, then we need to split these shares into the two components. So to compute the shares issued at full market price, we say number one, compute how much amount was received by the company from the right issue. We take the shares which were issued, which are basically 63, times the issue price. During the right issue, the shares were to be issued at a price of 15. At a price of 15, and then we divide that with the theoretical exercise price, which is 21. Then these shares must be weighted on time basis. They were issued from on January. The year is ending August. They were held for 8 months out of 12. So the bonus element is equal to the total shares which were issued during the right issue. This one, 63 minus the shares which were issued at full market price. The shares issued at full market price is what we have here. Just repeat that here. So we have 63 times 15 divided by 21, and then these shares are not supposed to be weighted on time basis. They're not supposed to be weighted on time basis. If you check on what we did in the other question, the same thing. So we have 63 times 15 divided by 21 times 8 divided by 12. And basically this is coming to this the 3,000. I hope that is what you're getting, 3,000. So what about this one? 63 times 15 divided by 21. So, and yes, and basically this will give us 1,800. Confirm whether you're getting the same. Confirm, yes, that is already confirmed, yes. So basically that's how we deal with that. Then next, let's go to point number 4, which will be the last point. The last point. Is there any difference in terms of how we have handled that late issue with what we did in our previous class? Any difference, Anne? Douglas, any difference? Ida, any difference? Steve, any difference? No difference. So just understand how we deal with that word, right? Issue. I've said is a concept you will come across in all questions for earnings per share. So then number 4, we are told on, that is the number 4, the 14% convertible note in issue is converted into ordinary shares at the holder's option on the basis of 50 ordinary shares for each shillings 100 of the raw notes. And then you're told on 1st of March 2024, holders of shillings 20 million of the convertible raw notes exercise their conversion option. What does that mean? That holders of shillings 20 million convertible raw notes exercise their conversion option. It basically means that convertible notes having a value of 20 million, they were converted into ordinary shares. Now, what we need to do here is we basically determine how many ordinary shares were issued on conversion. Remember what we said in our previous class, that Ordinary shares issued on conversion of convertible securities, we treat them as an equivalent of the shares issued at full market price. We must weigh them on time basis. So therefore, on 1st of March, as per the information we have in the last paragraph of that point number 4, 1st of March 2024, we say there was conversion of 14% convertible raw notes. Convertible raw notes. So we need to compute how many ordinary shares here were issued on conversion. We need to have the conversion rates, which basically we have in the first sentence of point 4. We are told the 14% raw notes in issue are convertible into ordinary shares at the holder's option on the basis of 50 shares for each shillings 100. For each shillings 100 of the raw notes. So in other terms, raw notes having a value of 100 shillings will be converted into 50 ordinary shares. In the last sentence, we are told shillings 20 million of the convertible raw notes were converted into ordinary shares. We need to determine how many ordinary shares were issued on conversion. We basically cross multiply, then we divide. Cross multiply, then we do what? We divide. So we will cross multiply, then we divide. We have 50. And remember, we are working with all our figures in thousands of shillings. This one, we will take it as 20,000. We divide that with what? We divide that with 100. With 100. And then whatever you get here, we will get the number of ordinary shares which were issued on conversion. And these ones are treated just like shares issued at full market price. We must weigh them on time basis. So they will be held for how many months? March, April, May, June, July, August. So those are basically 6 months. I hope you're getting that. Yes, because you have said March, April, May, June, July, August, 6 months. So let's work out that. So you have 50 times 20,000 divided by 100, then half of that, which is basically 5,000. 5,000. And we are done. We are done. So what we need to do is now we compute the one-offs. We compute the weighted average number of ordinary shares. So let's work out all that. We add all these from 94.50 to 5,000. We add all those values. 94.50 plus 26.25 plus 3,000 plus 1,800 plus 5,000. And basically, this will give us 21,875. Are you getting that value? Is that what you're getting? Yes. So I think having done, we basically move and compute the basic earnings per share, which will be equal to PATOS, which basically we already have here, 35,970. That is 35,970 divided by 1/0, which is this one, 21,875. Yes, so this will give us what? Yes, so this will give us shillings 1.644 per word per share, shillings 1.644 per word per share. And basically we have done. So what will earn you some marks there is basically what we have here. So computation of that one, there's some marks for that. And basically all these, including the computation of the theoretical exercise price. There is always a mark given to that. Yes. So finally, let's move to Roman 2. And what are we required to do here? We are required to compute the diluted earnings per share. Diluted earnings per share. And equally is for the year, which ended 31st of August 2024. Now, remember, we have said that this diluted earnings per share is usually computed by companies having potential ordinary shares. And I think there is something I forgot to explain, or in other terms to discuss in relation to this, but I think I can just quickly summarize that here. This is just like a summary of what we have discussed. How do you, or which steps do you use in computation of diluted earnings per share? If you come across a question, you are required to compute diluted earnings per share. Which steps do you need to follow here? 3 basic steps. Number 1, you need to identify, like the question we have there, identify the potential ordinary share or shares which our company was having in this year. Identify the potential ordinary share or shares the company was having during this year. Remember, when checking for these potential ordinary shares, you'll be checking for things like convertible securities. Were there convertible securities issued by the company? Number two, you'll also need to check were there some stock options or stock warrants granted to the employees. So that's the first thing. Number two, you compute increase in earnings, and increase in number of shares, for each potential ordinary share. That is step two. For each potential ordinary share, compute the increase in earnings, increase in number of shares, and you have to remember how we compute that. We have discussed that, and then finally compute the diluted earnings per share. Compute the diluted earnings per share using the formula which I gave you. Yes, those are the three basic steps to be followed in the computation of diluted earnings per share. So therefore, what we need to do, we need to go back to our question here, and basically we identify the potential shares our company is having during the current year. So remember, the potential ordinary shares, you check for whether the company had issued any convertible security, and number two, were there some stock options granted to the employees? That's the first thing we need to do here. We identify the potential ordinary share or basically shares issued by who? Issued by the company during the current year. Now, let's go back to this particular question, and that is basically the first thing we need to do. Which potential ordinary shares was our company having during the year under consideration? Potential ordinary shares. Which potential ordinary share can you see here? You check whether the company had issued any convertible security, and equally, were there some stock options granted to the employees? What can you be able to see there? 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 Yes, what can you be able to see from the information we have here? Yes, I'm told by Douglas we have convertible notes. We have convertible notes. Yes, in our question here, we actually have only one. We actually have one convertible. We only have one potential ordinary share, only one. Basically, whatever you have below paragraph 1, specifically where we have non-current liability. So we only have one, and that is 14% convertible raw notes. Convertible raw notes. So having that, we then need to move and we compute these two items: increase in earnings and increase in what? The number of ordinary shares. And remember what you are saying. For us to be able to compute that, basically we need to assume that these convertible notes were converted into ordinary shares during the current year. But now there is some information we need to recall here. The information which are given specifically note number 4 there. First of all, the current year we know ended on 31st. This year ended 31st of August 2024. The year started 1st of September 2023. Now, if you go back to the information below paragraph 1, the information you have below paragraph 1, so the 14% convertible debentures issued at the start, they had a value of 40 million at the start. And then what we know as per note number 4, let's go to note number 4, the last sentence. We are told on 1st of March 2024, some of these convertible notes were converted into ordinary shares. And actually, the ones which were converted into ordinary shares, they had a value of 20 million. These ones were converted. So meaning that the difference between this and this, that is still 20 million. 20 million. These ones were not converted. These ones were not what? Were not converted. So what does that mean? It basically means that, and basically here we have said we have 6 months. Here we have 6 months. So it basically means that during the first 6 months of the year, the convertible notes issued by the company had a value of 40 million. During the last 6 months, the convertible notes issued by the company had a value of 20 million. That information is very, very important for you to be able to compute these two values here. Increase in earnings, increase in what? The number of ordinary shares. I think we need to start by computing the increase in earnings. Now, for you to be able to compute this, you have to recall the formula which I gave you. How do we compute the increase in earnings here? In relation to convertible raw notes, convertible debentures, convertible bonds. I've said the increase in earnings is equal to interest which was paid, which was paid by the company, but that interest we take it net of tax. We take it net of tax. That formula you have to remember that formula there. So having that, we need to move and we compute the interest which was paid. Now, in the first 6 months here, the company will pay an interest of how much? The company will pay an interest of 14% of the convertible notes which had been issued for the first 6 months. That is 40 million, but we can work with that as 40,000. So this now will be the interest which will be paid for the first 6 months. You see, this 14% is per annum. So whatever we get here, 14% of this is per annum. But what we're interested with is interest for 6 months. That's why we are multiplying that with 6 all over 12. And then we compute the interest to be paid in the last 6 months. So the interest to be paid in the last 6 months will be 14% of these convertible notes issued in the last 6 months, 20 million. We can work with that as 20,000, sorry. So because that first of all will be per annum, but we're interested with the interest for 6 months. We multiply that with 6 all over 12. That basically will give us the interest to be paid by our company for the whole year. For the whole what? Year. For the first 6 months, for the last 6 months. And then we multiply that with 1 minus what? Tax rate. Tax rate, that is something which are given in the last note, note 5. The corporate tax rate applicable to this company is 30%. So we take 1 minus 0.3, and basically that will be 0.7. 0.7. 0.7. That's basically how we compute that. The interest which was paid by the company, but basically net of tax. The interest paid by the company net of tax. Sasa, yes, I hope you have understood what you have done here. Let's work out this interest which was paid net of tax. So we have 14% times 40 divided by 2. Basically, that will give us 28. What about that one? That will be 28. Half of that will be 14. 28 plus 14 times 0.7. I'm getting 2940. Yes. That is also the same figure I have from Douglas there. 29 what? 40, 29, 40. 29, 40, 29 what? 40, 29, 40. Yes. Basically, that's what we have. That's what we have there. Yes. So next, we need to compute the increase. Next, we need to compute the increase in what? In number of number of shares. Increase in number of what? Of shares. Increase in number of shares. So how do we compute the increase in number of shares? Now, for us to compute this, we need to have the conversion rate. The rate at which these convertible notes are supposed to be converted into ordinary shares. That conversion rate, we have it in note number 4, the percentages. And actually, we have used that one here. So we are told in note number 4, the 14% loan note in issue is convertible into 14 ordinary shares at the holder's option on the basis of 50 shares for every shillings 100 of the convertible raw notes. Now, basically, in our case, what we need to do for us to be able to compute this increase in number of shares, we have said we assume that these convertible raw notes were converted into ordinary shares during the current year. If that is the case, how many ordinary shares would have been issued on conversion? So basically, in our case, from this analysis which we have here, in the first 6 months, we know the convertible raw notes issued by the company, they had a value of 40 million. They had a value of 40 million, but or maybe 40,000. So in this case, what we need to do is to compute how many ordinary shares would have been issued if the conversion took place during the current year. But also remember, this one will only apply for the past 6 months. We will only apply for the past 6 months. And then in the last 6 months, the convertible notes issued by the company, they had a value of 20 million. They had a value of 20 million. So we equally need to compute how many ordinary shares would have been issued on conversion. You need to understand what you're doing here. So we will start we will start with the first 6 months. In the first 6 months, I'll basically first of all deal with whatever you have here. Whatever you have here. I'll basically ignore this. I'll ignore this. Yes. So I'll basically cross multiply, then we divide 50, 50, 50 this one times 40,000, this one divided by 100. But basically, we are saying that will only apply for the first 6 months of the year. So we need to multiply that with 6 all over 12. And then in the last 6 months, now we ignore this, we ignore whatever you have here, we deal with this and this. So we take 50 times this one, and then we divide with this. Remember, we're ignoring whatever you have here. Divided by 100 times 6 all over 12. Times 6 all over 12. This basically how we get the increase in number of shares. These are the number of ordinary shares which would have been issued during the current year, assuming that these convertible notes were converted into ordinary shares. So what do we get here? So this basically will give us 1, 2, 3, 4, 20. Sorry. So we have this will be 20, 1, 2, 3, 4. Basically half of that, which will give us 100,000. So this will give us 10, 1, 2, 3, 4, 1, 2, 3, 4, and basically half of that, which will give us 5. Which will give us 5. Is it 150,000? 15,000? 15,000 or 150? Because this will be 20. 150,000 or 15? Maybe just confirm. Are you getting 15,000 or 150,000? Okay. So I'm told it will be 15,000. It will be 15,000. It will be 15,000. And basically these are what? These are shares. Now having this, we are done with step 2. Finally, in step number 3, we compute what? We compute the diluted earnings per share. So the diluted earnings per share, we apply this formula. We take the PATOS divided by 1/0. To the PATOS, we add increase in earnings. And then to this, we do what? We add increase in the number of what? Of our shares. The number of shares. Okay, so I'm told this one should be 100. Yes, this one should be 100. Okay, thank you for that. Okay, so basically we need to apply this formula. So we have the PATOS. The PATOS one, these are the one used in the computation of basic earnings per share. We have them here. So PATOS is 35,970. To this, we add increase in earnings. The increase in earnings is what you have computed here, 2940. We divide that with 1/0, which we have here, 21,875. And then to this, we add increase in number of shares, this one, 15,000. 15,000 is that. Yes, so we are basically done. What we need to do is to compute the base, to compute what? To compute the diluted earnings per share. So give me the final value here. Yes, I'm told this will give us 1.055 shillings per what? Per share. Shillings per what? Per share. Yes. So basically that is it. That what was required as far as that question is concerned. The computation of the basic and also what? The diluted earnings per share. Yes. So basically that brings us now to the end of that particular topic on earnings per share. Once we meet in our next class, automatically we're going to move to another topic. We will not do any other question, but if you check on those particular past papers, including the teaching, there are so many questions on earnings per what? Per share, on earnings per share. You can basically attempt some of them, and maybe during our revision, we will maybe attempt more questions. We will basically attempt more questions coming, or basically during our revision. Sasa, yes. So I want us to stop at that particular point, unless maybe there is a question. Unless there is a question, I want us to stop at that point. Is there any question? Is there any question? Any question? Any question? So I think there is none. So let's stop at that point for now. You have a good night. We continue from there tomorrow as we move to a new topic. So have a good night. See you tomorrow.